Subscribe to my channel Report Stock.
Welcome to the Deep Dive, where we cut through the noise to get right to the insights that truly matter. Today, we're taking a deep dive into something that, well, might seem like just another financial report on the surface. But trust me, it's actually a gold mine for understanding, consumer behavior and the broader economic currents shaping things.
Absolutely. We're talking Home Depot.
Exactly. Huge retail giant, household name for home improvement.
And their recent financial results, they offer this really fascinating mix of signals.
Right. So our mission today isn't just about hitting or missing targets. It's about really getting under the hood of Home Depot's second quarter fiscal 2025 earnings report and their outlook for the full year.
Yeah, we want to go beyond those headlines, understand what's really driving their performance, maybe what challenges they're facing.
And what their plans might mean for the whole home improvement sector, really.
Okay, so just to give you that initial snapshot.
Yep.
You might have seen headlines saying both sales and earnings missed the Zacks consensus estimate, which is basically the average prediction from financial analysts for anyone not familiar.
Right. But here's where it gets interesting. Despite missing those predictions, both numbers actually improved compared to last year.
Yeah, year-over-year growth. And comparable sales were up too.
So it's not a simple win or loss story at all. It's much more nuanced, and that's exactly what we're going to unpack.
Okay, let's do it. Starting with those headline numbers, the miss first.
Yeah, let's start there. So adjusted earnings were $4.68 per share. The Zacks consensus estimate was $4.71. So just slightly below.
A near miss, really.
Pretty much. And net sales came in at $45.3 billion, while the estimate was $45.5 billion. Again, lagging, but not by a huge amount.
Okay, so on paper, maybe a slight disappointment compared to expectations.
And this is the important part. If you look year over year.
That's where the picture changes.
Exactly. Those earnings, the $4.68, that's actually up 0.2% from $4.67 last year.
Okay, slight increase.
And net sales, the $45.3 billion, that's up a pretty solid 4.9% from $43.2 billion a year ago.
So even though they didn't hit Wall Street's target, the business itself grew compared to the previous year, which says maybe more about the expectations than the actual health.
That's a great point. And then there's comparable sales, that key metric for stores open at least a year.
Right. How are the existing stores doing?
They saw a 1% increase overall, and actually a bit stronger in the U.S. specifically at 1.4%.
Okay, so positive movement there.
Although worth noting, unfavorable foreign exchange rates did trim that down a bit, took about 40 basis points, or 0.4%, off the total comparable sales number.
Ah, the joys of global business. Always a factor.
Always something. But what's really interesting is how management is framing this. They sound pretty confident.
Yeah, they're talking up their initiatives, saying they see continued momentum, especially in smaller home improvement projects.
And they keep emphasizing this focus on an interconnected customer experience.
Yeah.
Blending online and physical stores.
Plus, growing market share. And based on all that, they actually reaffirmed their guidance for the full fiscal year 2025.
Okay, let's dig a bit deeper now into the customer side, because this is where we see some intriguing trends.
Yeah, the who and how much of the spending.
Right. We said comparable sales were up, but if you look at the number of transactions.
Ah, okay. What's happening there?
Well, customer transactions were actually down 0.9% compared to last year. About 446.8 million transactions.
Down. But comparable sales were up. How does that work?
Fewer people walking through the door or maybe clicking buy online.
Okay.
The answer is in the average ticket size. That improved by 1.2% year over year.
Ah, I see. So fewer shoppers overall, but the ones who are shopping are spending a bit more each time they do.
Exactly. What do you think that implies?
Well, it suggests maybe fewer casual trips, fewer small impulse buys. Perhaps people are coming in or going online for more specific planned projects.
Right, maybe slightly bigger ticket items for those projects.
Could be. It paints a picture of a more maybe deliberate consumer. They know what they need, they get it. Maybe it's a slightly higher value item, but they're not browsing as much, perhaps.
That makes sense. Purposeful spending. Okay, so that's the revenue and customer side. Now let's flip to the cost side of the equation. This is where margins can often feel the squeeze.
Yeah, always critical to look at costs. What's the gross profit picture?
Gross profit looks pretty solid, actually. It rose 4.9% year over year, hit $15.1 billion.
Okay, tracking with sales growth.
Yep. And the gross margin held steady, around 33.4%, roughly flat compared to last year, and pretty much right where their models predicted it would be.
All right, so far so good on that front. No major pressure there.
But And here's where it gets, as you said earlier, really interesting. SG&A expenses.
Ah, selling, general, and administrative costs. What happened there?
They rose significantly, up 8.7% to $7.8 billion.
Wow, 8.7%. That's quite a jump, faster than sales growth.
Definitely. And as a percentage of sales, SG&A climbed to about 17.1%. That's up roughly 60 basis point, 0.6% year over year.
Which is even a bit more than the 50 basis points their models had predicted.
Exactly. So costs are rising a bit faster than expected there. Why do you think that 8.7% jump happened? Investments, inflation.
It's likely a mix, isn't it? You could have higher labor costs paying staff more, maybe investments in that tech for the interconnected experience we mentioned.
True, upgrading systems isn't cheap.
Or even higher marketing spend to attract those more focused shoppers. Whatever the drivers, it means they're spending more to bring in each dollar of revenue.
And you see the direct impact of that when you look at operating income.
Right, because SG&A comes out before operating income.
Precisely. So operating income only saw a tiny increase, just 0.3% year over year, reaching $6.6 billion.
Much smaller increase than sales or gross profit.
Much smaller. And crucially, the operating margin, it contracted, fell by about 65 basis points or 0.65%, down to around 14.5%.
Which was actually in line with what the models expected, interestingly enough.
It was. But it clearly shows that even though sales grew, those faster rising SG&A costs really put the pressure on the operating margin.
Yeah, they're keeping a slightly smaller slice of profit from every dollar of sales. That highlights the challenge, doesn't it? Rising costs are definitely eating into the bottom line gain from higher sales.
Okay, so that was the quarter. Let's get a quick snapshot now of their overall financial health and what they see coming down the path.
Sure. How are they looking financially overall?
Pretty solid, actually. At the end of Q2 fiscal 25, they had $2.8 billion in cash and equivalents.
Okay.
They do carry significant long-term debt, about $45.9 billion. And stockholders' equity was $10.7 billion.
And cash flow. How's the cash generation from operations?
Strong. They generated $9.0 billion in net cash from operating activities just in the first half of the fiscal year.
$9 billion. That's substantial. Shows the core business is still throwing off a lot of cash.
Definitely indicates a solid financial footing, even with those margin pressures we talked about.
All right. And connecting this forward, what about the outlook for the rest of fiscal 2025? They reaffirmed guidance, you said.
They did. They're sticking with their forecast. They expect sales to be up 2.8% for the full year.
Okay.
And comparable sales up 1% for the full 52 weeks.
So continued modest growth expected.
Seems so. They're estimating a gross margin of 33.4%, basically holding steady, and an operating margin of 13%. The adjusted operating margin is slightly higher at 13.4%.
13% operating margin. That's down from the 14.5% in Q2, reflecting that ongoing pressure.
It is. And they're still planning to grow their footprint, opening 13 new stores this fiscal year.
Okay, still expanding.
But here's the really key takeaway from the guidance, the part that you really need to understand.
What's that?
Despite the sales growth forecast, the company anticipates earnings per share to actually decline.
Decline, even with sales going up.
Yep. They expect reported earnings per share to fall 3% year over year, and adjusted earnings per share to fall 2%.
Wow. Okay, that's significant. So the cost pressures and maybe some other factors are expected to more than offset the revenue growth when it comes to the bottom line per share.
That seems to be the story they're telling with the numbers. It's a really crucial point.
And how is the market reacting to all this? You mentioned the Zacks rank earlier.
Right. Well, their shares gained 4.7% in the past 3 months, which sounds okay.
Nice.
But it actually underperformed the broader industry, which grew 6.5%.
Okay, so lagging the sector a bit.
Yeah. And that Zacks rank is #3, which means hold. Basically, analysts are saying they expect it to perform roughly in line with the market, not necessarily outperform.
And they're still investing, right? Capital expenditures.
They are. They anticipate spending about 2.5% of total sales on capital expenditures. So continued investment in the business, infrastructure, stores, tech, probably. So wrapping this all up, this deep dive into Home Depot, it really shows a company performing this, well, delicate balancing act.
Mm-hmm. It really does. You've got sales and comparable sales growing, which is good.
And that clear focus on smaller projects, improving the customer experience across online and in-store, that all sounds positive strategically.
Absolutely. But then you have the other side of the scale, those rising expenses, especially the SG&A we talked about.
Putting undeniable pressure on the operating margins.
And it's significant enough that, as you highlighted, they're actually forecasting a drop in earnings per share for the full year.
Yeah, it's such a nuanced picture. Growth, yes, but growth that's being dampened by rising costs.
Exactly. Growth, but maybe less profitable growth for now.
Which leaves us, and you, with a final thought to chew on.
Okay, what's the provocative question for today?
Given these trends we've seen at Home Depot, fewer customer visits, but higher spending per visit.
Right, that deliberate shopper idea.
And their strategic focus on smaller home improvement projects. What broader insights could this offer about, say, consumer confidence in the economy?
Interesting question. Like, what does it say about our willingness to tackle those huge, expensive renovations versus just smaller, more manageable upgrades?
Exactly. Are people pulling back on the big stuff? And what could this type of behavior, this shift perhaps, signal about the future of discretionary spending, especially in the economic climate we're in right now?
That's a great question to ponder. Fewer big splurges, more targeted fixes. What does that tell us? Something to think about.
Subscribe to my channel Report Stock.